Hash strategies, psychology, and macro thinking. Imagine sitting in front of a trading screen at 6 a.m. Futures are moving. Currencies are fluctuating. Financial television is screaming about inflation, interest rates, elections, and market crashes. Most traders are focused on one thing: what's happening today? But Jim Rogers approached markets differently. He asked a completely different question. What major change is happening beneath the surface of the world? That difference in perspective is what made him extraordinary. Because while most investors searched for the next stock, Jim Rogers searched for entire countries, industries, and economic systems that were quietly transforming. And that's the real lesson from these pages. Not prediction. Not hype. Not complicated indicators. Transformation. Rogers understood that the biggest investment opportunities usually appear before the crowd notices them. And modern traders can learn an enormous amount from that approach. The core principle: follow change before the crowd. One of the strongest ideas throughout these pages is that markets reward investors who recognize change early. Most people wait until conditions feel comfortable. But by the time conditions feel comfortable, prices have often already moved. Jim Rogers constantly looked for situations where reality was quietly improving while public perception remained negative. That gap between perception and reality creates opportunity. And one of the clearest examples was Portugal. During the 1970s, Portugal looked politically unstable and economically weak. Investors avoided it. Capital fled the country. Fear dominated sentiment. But Rogers noticed something important. Conditions were beginning to improve. Not perfectly, not dramatically, but direction matters more than headlines. That's one of the most important lessons traders can understand. Markets move based on change. A terrible situation becoming slightly better can produce enormous gains. A great situation beginning to weaken can produce huge losses. Rogers focused intensely on direction. That gave him edge. Strategy wanted by improving conditions. Modern traders spend enormous time searching for perfect setups. Jim Rogers searched for improving conditions. That's a powerful distinction. He didn't need a country to look perfect. He needed it to be healing. And this principle applies far beyond countries. It applies to stocks, commodities, currencies, sectors, entire economies. The question becomes, is this situation getting stronger or weaker beneath the surface? That's the question elite traders constantly ask. Most market participants react emotionally to current headlines. Professional investors study transitions. For example, a company may still look weak financially, but if losses are shrinking and demand is stabilizing, the market often rises before the headlines improve. A sector may still appear unpopular, but if institutional money quietly begins accumulating positions, a major move may already be starting. Rogers trained himself to identify these shifts before they became obvious. That skill remains incredibly valuable today. Strategy 2: think like a contrarian. Jim Rogers was a disciplined contrarian. That does not mean blindly opposing the crowd. It means recognizing when public perception has become emotionally distorted. Markets constantly swing between fear and greed. During fear, investors become overly pessimistic. During greed, they become unrealistically optimistic. Both extremes create opportunity. Rogers understood that emotional extremes often disconnect prices from reality. That's where disciplined traders gain advantage. One of the most dangerous habits in trading is needing social confirmation. People feel safer when everybody agrees. But consensus usually arrives late. By the time everyone believes an opportunity is obvious, much of the move is already finished. Rogers repeatedly entered markets before they became fashionable. That psychological independence separated him from average investors. And traders today desperately need this mindset. Because social media amplifies emotional crowd behavior. People chase momentum, panic during volatility, copy opinions, follow hype. But markets reward independent thinking, not emotional imitation. Austria: the power of early research. Rogers later turned his attention toward Austria. At the time, Austria was not considered exciting. But Rogers noticed subtle political and economic changes. Government incentives were appearing. Capital markets were opening. Economic liberalization was quietly developing. Most investors ignored these developments. Rogers investigated further. And this introduces another major strategy: primary research. He didn't simply trust headlines. He traveled. He spoke to officials. He investigated conditions directly. That's an enormous lesson for traders. Most people consume second-hand opinions. Elite investors gather first-hand understanding whenever possible. Even in modern markets, this principle matters. You can study consumer behavior, industry shifts, capital flows, policy changes, business trends. The deeper your understanding becomes, the less dependent you are on crowd psychology. Rogers discovered that official Austrian market data badly underestimated reality. That's critical. Markets are not perfectly efficient. Information can be delayed, misunderstood, ignored, distorted. That creates opportunity for disciplined traders who investigate deeply. Strategy 3 is study macro trends. Jim Rogers was a macro thinker. He understood that enormous market moves are often driven by large economic trends. Most traders become trapped in short-term thinking. Every day feels urgent. Every price movement feels important. But many fortunes are created by correctly identifying major long-term trends. For example, currency changes, commodity cycles, government policy shifts, economic liberalization, demographic trends, capital flow transitions. Rogers constantly studied these forces, and modern traders should too, because understanding macro context improves decision-making dramatically. For instance, a strong company inside a collapsing economic environment faces enormous pressure. Meanwhile, an average company operating inside a powerful economic trend may rise significantly. Macro environments matter. This is why Rogers paid close attention to currencies, liquidity, government incentives, and political direction. He understood that markets are connected systems, and traders who understand systems often outperform traders who focus only on charts. Germany, understanding bubbles. One of the most important sections in these pages involves Germany. Rogers recognized that German markets were entering a speculative phase. Optimism was rising, capital was flowing, excitement was building, and this teaches a crucial trading lesson. Bubbles follow predictable emotional patterns. First comes disbelief, then curiosity, then optimism, then greed, then mania. At the final stage, people stop caring about risk. Narratives replace discipline. This happens repeatedly throughout market history. Technology bubbles, housing bubbles, cryptomanias, commodity booms. Human psychology does not change. Rogers understood that successful trading requires emotional detachment. He could participate in a rising market without becoming emotionally attached to the story. That's rare. Many traders fall in love with narratives, but the market rewards adaptability, not emotional attachment. Rogers eventually sold after enormous gains because expectations had become excessive. That discipline matters. A good investment can become a dangerous trade when optimism becomes irrational. Strategy 4 understands cycles. Another major lesson from these pages is the importance of cycles. Nothing rises forever. Nothing falls forever. Yet investors repeatedly behave as though current conditions will continue indefinitely. Rogers understood that human beings naturally extrapolate the present into the future. That psychological tendency creates bubbles and crashes. One example involved Norway. Oil revenues created enormous optimism. Confidence surged. People believed prosperity would continue endlessly. That belief itself became dangerous. Rogers recognized excessive optimism and shorted the market. This teaches a powerful principle. Extreme optimism often signals rising risk. Extreme pessimism often signals rising opportunity. Modern traders constantly struggle because they emotionally react to trends instead of studying cycles. Disciplined investors ask, where are we emotionally inside the cycle? That question can completely change risk management. Strategy 5 follow incentives. One of Rogers' most practical insights involves incentives. He closely studied how governments treated investors and capital. Singapore encouraged investment, reduced barriers, created investor-friendly conditions. Malaysia eventually followed similar policies. Rogers understood that capital moves toward environments where it is welcomed. That's a massive lesson. Markets are shaped by incentives, taxes, regulations, currency stability, liquidity, political behavior. These forces influence where money flows. Many traders ignore these structural conditions, but Rogers built enormous success by understanding them. Even today, traders should constantly monitor. Where is capital moving? Which environments encourage growth? Which sectors are attracting investment? Which policies are changing behavior? Because money leaves clues. Brazil opportunity often looks messy. Rogers also discussed Brazil. At the time, Brazil looked chaotic. Currency instability, economic difficulty, restrictions. Most investors avoided it. But Rogers recognized that massive opportunities can exist inside imperfect systems. That's another critical lesson. Great investments rarely feel emotionally comfortable at the beginning. The crowd wants certainty, but certainty usually appears after the opportunity has already moved. This does not mean blindly buying weak markets. It means understanding the difference between temporary fear and permanent destruction. That distinction creates edge. Some of the greatest trades in history emerged from environments that initially looked unattractive. Rogers focused on transition, not perfection. Strategy 6 builds psychological independence. Underneath all these stories lies a deeper lesson. Psychology drives markets. Fear, greed, envy, hope, panic, overconfidence. Most trading mistakes are emotional before they are analytical. Jim Rogers developed extraordinary psychological independence. He could buy when others were fearful, sell when others became euphoric, wait patiently while others demanded constant action. That emotional control became one of his greatest advantages. Modern traders often underestimate how much emotional discipline matters. Indicators are easy to learn. Psychological control is much harder. Can you remain patient? Can you avoid impulsive decisions? Can you think independently? Can you tolerate uncertainty? Those abilities separate professionals from emotional traders. Strategy 7 patience creates asymmetry. Another powerful lesson from Rogers is patience. Most traders destroy themselves through overactivity. They constantly need stimulation, constant trades, constant predictions, constant excitement. But major fortunes are often built by identifying a powerful trend early and allowing time to work. That requires patience. Rogers understood that large macro trends unfold slowly. Economic transitions take years. Capital flows develop gradually. Market psychology evolves over time. Patience allows traders to benefit from compounding trends. Impatience creates emotional exhaustion. This is why disciplined waiting can become a competitive advantage. Sometimes the best trade is holding a high conviction position while others become distracted by noise. Strategy 8 observe reality, not headlines. Rogers constantly traveled because he wanted to see reality firsthand. He understood that media narratives often distort conditions. That lesson matters enormously today. Modern traders consume endless information. But information is not the same as understanding. Headlines are emotional. Reality is often more nuanced. Rogers focused on what was actually happening beneath the narrative. Was infrastructure improving? Was business activity increasing? Was policy changing? Was capital returning? These deeper observations mattered more than short-term media noise. Traders today should ask themselves, am I reacting emotionally to headlines? Or am I studying underlying reality? That distinction can dramatically improve decision-making. The 4 tests of a strong opportunity. One of the most practical frameworks Rogers discusses involves evaluating countries using 4 major questions. First, is the situation improving significantly? Second, is reality better than public perception? Third, is the currency becoming more stable and trustworthy? Fourth, is liquidity improving? This framework can also apply to sectors, companies, and industries. The strongest opportunities often involve improving conditions, negative perception, increasing confidence, growing participation. When these elements align, major trends can emerge. Frameworks like this help traders remain rational during emotional markets. Lessons for modern traders. So what are the most important lessons modern traders should take from Jim Rogers? First, study change. Markets reward investors who recognize transitions early. Second, think independently. Consensus often arrives too late. Third, understand psychology. Emotional extremes create opportunity. Fourth, study macro conditions. Currencies, liquidity, incentives, and policy matter. Fifth, develop patience. Big trends take time. Sixth, focus on reality rather than headlines. And seventh, train in emotional discipline, because markets constantly test psychology. Final reflection. At the deepest level, these pages are not really about countries. They are about perception, psychology, change, and independent thinking. Jim Rogers succeeded because he learned to recognize transformation before the crowd. He studied cycles, understood incentives, observed reality carefully, and remained psychologically independent. That combination gave him enormous edge. Modern traders live in a world overflowing with information but starving for clarity. Jim Rogers reminds us that the real edge often comes from calm observation, not emotional reaction. The next great opportunity may not look obvious, It may not appear on financial television. It may not feel emotionally comfortable. But if conditions are quietly improving beneath the surface, if perception is lagging behind reality, if fear still dominates while transformation begins, that may be exactly where opportunity lies. And traders who learn to recognize those moments before the crowd arrives are often the traders who achieve extraordinary long-term success.